Welcome back to Everyday Economics. This is the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug. I'm the CEO of the 501c3 Franklin News Foundation. Everyday Economics production of America's Talking Network, and you can listen to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Friday, January 10th. And joining me as always, my friend, colleague, and co-host, Dr. Orphe Divounguy, PhD economist, an all-around good guy. Hey, Dr. O, we'll talk about credit today, and I guess maybe business finance, home consumer finance. It's a story that ran in Business Insider. I always kind of sort of squint at some of the work that they do, but it is an enterprise story. And they're taking a look at the number of bankruptcies filed last year, and it is a high number in relationship to previous years. 14-year high on the number of corporate bankruptcies filed in 2024, a total of 694. That's not great. It's the most they're reporting, haven't validated this, haven't verified this, but they're reporting that is the most that have occurred in any single year since the financial crisis. So what's going on there? Let's start there. I want to talk about consumer credit too, but let's start there with corporate and corporate financial responsibility.
Look, the reality is that interest rates have remained high for longer. Interest rates even surprised on the upside after the Fed rate cuts began. And so I think a lot of businesses are feeling the pressure. And so it's not surprising that we're seeing bankruptcies, corporate bankruptcies on the rise.
And I mean, can you, for the benefit of our audience, talk about how important it is for a business to be able to have access to cash and to be able to afford that access to cash?
Yeah, exactly. Raising money. Not a lot of small mom and pop businesses can do that. And so they rely heavily on debt. And the cost of debt has increased a lot, right? And now servicing that debt is very expensive, it's very costly, and is preventing them from expanding their operations. And potentially for some could cause them to start laying off workers, which is why we know hiring's been really low. So far, layoffs have remained low, but I think this is one of those other statistics that concerns me about where the labor market is headed. Right? I don't, despite the gangbuster jobs report we got for December, I am concerned that if the majority of U.S. companies, I shouldn't say majority, although it's true that the majority of publicly traded U.S. companies may not be profitable, that we're going to continue to see slowing in the labor market, and then weakness in the labor market could translate to weakness for consumers who basically, consumers that have basically been relying on income from their earnings to spend, right? We're starting to see, because debt is so expensive, we're starting to see credit card spending decline, right? Consumers are cautiously pulling back on taking on more debt, and really relying on their labor market, on their earnings from the labor market to continue to fuel their spending.
So let's talk a little bit about like consumer behavior right now, right? I mean, there was a story that came out, right after the first of the year. It was Fox Business took the story and ran with it, but it was from the Kobayashi letter, and they are reporting that the U.S. credit card defaults that to 46 point, I think it's $46.1 billion, in the first 9 months of 2024, which would be the highest number of that, in that category since 2010, which would put us back into the housing crisis. And that credit card defaults are up about 50% year over year. Are you seeing different data points with regard to consumer behavior? Because I'll tell you what, that story is somewhat buried. I had not seen anybody else pick that up. And I'm just trying to make sense. As you and I were talking beforehand, we were talking about consumer credit actually maybe going in the opposite direction, and maybe perhaps improving, that people were starting to rein in their spending.
Yeah, I mean, it's interesting because when you look at the Fed reports, quarterly Fed reports, total debt outstanding has increased, right? Continues to increase. But when you look at the debt as a share of income, remains very low. And so, sorry, not debt as a share of income, but the debt servicing remains very low. And so people are still, so in terms of overall debt burdens, households are still in a pretty good place, because their payments are low, especially when you add to that, of course, their mortgage payments, housing, right? Total debt servicing costs are somewhat low relative to before the pandemic, but it's rising. And I think that's where the concern is. I think the latest shows that in the last, I can't remember which report, I sent it to you this week, shows that basically in the past month or so, consumers have kind of pulled back a little bit on taking on more credit card debt, which is good because, if debt levels are already very elevated, a slowdown is necessary. Curbing that growth in total debt is necessary. And so consumers are cautiously pulling back. I think that's good news, but it also means that sustaining the pace of spending, overall spending in the economy. Remember, household consumption making up the largest share of the economy, basically means that if consumers pull back on spending substantially, then you could be headed into an economic downturn. So we still rely heavily. This economy relies heavily on the consumer and the state of the consumer. And if the consumer pulls back substantially, we're likely going to start to see some GDP growth stalling and potentially even going into negative territory. Right. So very important to keep track of the health of the consumer. And the labor market has been a source of, has basically been the fuel for consumer spending. Of course, on top of debt, but with debt now, with consumers now reining it in a little bit, or at the very least, not taking on additional debt. The labor market is crucial for us to continue to see the type of consumer spending activity that we're seeing out there. Remember, latest jobs report, 4.1% unemployment rate. I think that's good news. It means the consumer is still there. Layoffs remain very low, according to the JOLTS report that we got this past week. And as long as layoffs remain low, the consumer will be fine. If layoffs begin to rise, I think that's when we should start to worry.
Yeah, I mean, the one thing about American consumers is they go until they can't. So we'll have to see. We'll have to see what lies ahead. Appreciate your thoughts as always, Dr. Orphe. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and some fantastic other podcasts at americastalking.com.